Property titling and beneficiary designations are fundamental estate planning tools that determine how assets are owned during life and transferred upon death. These mechanisms significantly affect asset control, probate administration, taxation, creditor protection, and wealth transfer objectives. Financial planners must understand ownership structures because the manner in which property is titled often determines who receives assets, regardless of instructions contained in a will. Similarly, beneficiary designations provide a direct method of transferring assets outside the probate process. Effective coordination of ownership arrangements and beneficiary elections helps ensure that assets are distributed according to a client's wishes while minimizing administrative delays, transfer costs, and potential disputes among heirs and beneficiaries. Property titling refers to the legal method by which ownership of assets is established and documented. Common forms of ownership include sole ownership, joint tenancy with right of survivorship, tenancy by the entirety, tenancy in common, and ownership through trusts or business entities. Each ownership structure carries different legal rights and transfer implications. Sole ownership provides complete control but generally requires probate upon death. Joint tenancy allows ownership interests to pass automatically to surviving owners, bypassing probate. Tenancy in common permits owners to transfer their interests independently. Financial planners evaluate ownership arrangements carefully because titling decisions influence estate planning outcomes, asset protection strategies, and wealth transfer efficiency. Joint ownership arrangements are frequently used as estate planning tools because they facilitate the transfer of property outside probate. Joint tenancy with right of survivorship provides that ownership automatically transfers to surviving owners when one owner dies. This feature can simplify asset transfers and reduce administrative costs. However, joint ownership may also create unintended consequences, including exposure to creditors, gift tax considerations, and conflicts with broader estate planning objectives. Financial planners assess whether joint ownership aligns with a client's goals and family circumstances. While survivorship arrangements offer convenience, they must be coordinated with wills, trusts, and other planning documents to avoid inconsistencies and unintended distributions. Beneficiary designations represent another important method of transferring assets efficiently. Many financial assets, including life insurance policies, retirement accounts, annuities, and payable-on-death accounts, permit owners to name beneficiaries who will receive assets directly upon death. These designations generally supersede instructions contained in a will. As a result, outdated or improperly coordinated beneficiary elections can create unintended outcomes. Financial planners regularly review beneficiary designations to ensure consistency with current estate planning objectives, family circumstances, and tax strategies. Proper beneficiary planning can facilitate rapid asset transfers, reduce probate costs, and help ensure that wealth is distributed according to a client's intentions. Estate planning requires careful coordination between property titling and beneficiary designations because these mechanisms often determine the actual disposition of assets. A well-drafted will may not control assets held in joint tenancy or accounts with designated beneficiaries. Consequently, inconsistencies between legal documents and ownership arrangements can undermine estate planning objectives. Financial planners conduct comprehensive reviews of asset ownership structures, beneficiary elections, trust arrangements, and testamentary documents to identify conflicts and ensure alignment. Coordinated planning promotes efficient administration, reduces confusion among heirs, and minimizes the risk of unintended distributions. Effective integration of ownership and beneficiary strategies strengthens overall estate planning effectiveness. Strategies to transfer property involve various legal and financial techniques designed to move assets from one individual to another during life or at death. These strategies may serve objectives such as wealth preservation, family support, tax efficiency, charitable giving, business succession, and asset protection. Property transfers can occur through lifetime gifts, beneficiary designations, trusts, joint ownership arrangements, wills, and contractual agreements. Each method offers different advantages and disadvantages regarding control, taxation, flexibility, and administrative complexity. Financial planners evaluate available transfer strategies based on a client's goals, family circumstances, asset composition, and long-term wealth transfer objectives to develop effective estate planning solutions. Lifetime gifting is a commonly used property transfer strategy that allows individuals to transfer assets while retaining the opportunity to observe the benefits provided to recipients. Gifts may reduce the size of a taxable estate, shift future appreciation to beneficiaries, and support family members during the donor's lifetime. Trusts provide another powerful transfer mechanism by allowing assets to be managed according to specified instructions for the benefit of designated beneficiaries. Trusts can facilitate asset protection, tax planning, incapacity planning, charitable objectives, and multigenerational wealth transfer. Financial planners analyze gifting and trust strategies carefully to ensure compliance with tax rules and alignment with estate planning goals. Property titling, beneficiary designations, and transfer strategies are closely interconnected components of comprehensive estate planning. Ownership structures determine legal rights and transfer mechanisms. Beneficiary designations direct the distribution of specific assets, and transfer strategies provide methods for achieving broader financial and family objectives. Effective planning requires coordination among wills, trusts, retirement accounts, insurance policies, and asset ownership arrangements to ensure consistency and efficiency. Financial planners regularly review these elements to reflect changes in family relationships, financial circumstances, tax laws, and personal goals. By integrating titling decisions, beneficiary elections, and transfer strategies, clients can preserve wealth, simplify estate administration, and achieve successful intergenerational transfer of assets.